Hello, Dan Davis, Certified Financial Planner. Financial planning world is committed to equipping financial planners in their pursuit of excellence. We're proud to be sponsoring this series on best practices. Today's topic of financial planning is tax planning. I'm joined by Rich Kurowski, Certified Financial Planner. He is instrumental in helping me at ADK Wealth Advisory Group to do a lot of the tax work for our clients behind the scenes. Rich, thank you so much for joining us today.
Good morning, Dan.
When we do the tax planning work for our clients, what's the main objective?
The primary objective, Dan, is really get the best possible picture we can of the current year tax status for the client. So that means probably the most obvious thing we're looking for is what is the taxable income, and given that, what's the tax bracket that the client is. But we go probably a step deeper, I would say, because there's other measurements that you're not going to get on a normal tax return, but there's other numbers that are going to affect the decision making that we do. That includes adjusted gross income, some concepts called provisional income, which determines how much Social Security income might be taxed, a term called MAGI, which can mean many things, but the acronym itself is Modified Adjusted Gross Income. This affects the amount of Roth contributions, deductible IRA contributions. It affects how much of it also affects the amount of a client's Medicare premium, for instance. Basically, what we're trying to do ultimately is give the client some advantage in terms of, or tax advantage in terms of the decisions we're making. So again, we go probably a little deeper than you would normally go in just a sample tax return for
Excellent.
the year.
So when is it optimal to do this work for our clients?
Really any time of the year, and there are certain situations where clients might want to do this earlier than later, but the best time really is later in the year, preferably Q4, because at that time we've got pretty much the best information we're going to get on where a client is going to stand for the current year. We know how much we can get a good estimate on the dividends they're going to have. We've got a somewhat of an estimate on capital gains distributions, and we got a good feel too for what we think their income is going to be. So really, if we can do it, we do it say from October on, Q4 of the year, so that we got the best picture possible at that point, best accurate picture.
Tell our viewers how we use this tool to guide and help our clients.
We gather two pieces of information, I would say. First of all, we'd like to get the client's previous year tax return as a baseline. It gives us pretty much a sanity check on where the client stands. And then we use the sheet that we're illustrating here and ask the client to give us the most accurate and current information for this year. That's so we know that we know whether anything has changed since that last tax return was filed. And there's information here too that we gather from the client's accounts that we have access to, such as capital gains, dividends, tax-exempt interest. But all that combined gives us the best picture based on the results of this tax analysis. There's a lot of decisions we can make. There's a lot of transactions or potential actions that a client can take based on their tax status. For instance, do they want to do a Roth conversion? Okay. We'll look to see where a client stands as far as taxable income primarily and their tax bracket, and decide if it makes sense in that year to do a Roth conversion. And if we do the Roth conversion, we probably only want to do it up to approximately the top of the current bracket. We don't want to take a client into a higher bracket by doing a Roth conversion. So we'll make a decision on a Roth conversion, for instance. Another big factor is how the tax status is going to affect taxation of the client's capital gains. Will they pay capital gains tax? How much? We can either decide to do a Roth conversion, we can decide to take some capital gains. We might decide to do a combination of the two, really based on the client's portfolios, their current holdings, what their gains are, and ultimately what their tax status is going to be. Another thing we always keep an eye on too for a lot of clients is what their MAGI is, for instance, so that we don't want to make a move, take gains, take extra income, for instance, that might take them into a higher Medicare premium bracket. So we look at all those different things and come up with one optimal strategy for the client for that year, based on
Excellent.
their tax status.
Excellent. In your experience in doing this, what's the involvement of their CPA or their tax accountant?
It depends on the client. A lot of times the clients have that information. Many times, though, they'll give us permission to talk with their CPA, again, so that, number one, we make sure we got the most accurate information. And if there's questions about some specific situation that the client's involved in, the CPA may have more detailed or more accurate information on that situation. So with the client's permission, we'll contact the CPA and discuss it with them, and really make the decision and take any moves based on that consultation too.
In the 30 years that I've been doing this, probably the first decade, I relied on our clients' tax accountants to do this work. But really what we learned is that the CPAs that most of our clients work with are more reactive. If our client brings them information or questions, they'll get their taxes prepared, but very seldom do they get tax advice. So that's why Rich on our team steps into that void to help clients in that fourth quarter really evaluate, should we take some capital gains? And if we do that, what's the effect? A lot of times we're taking capital gains, someone's in the 12% tax bracket and they're not paying any tax on that. But when you do that, it does affect the taxable, some of the different taxable threads. So we have to understand, if we do that, what's the effect on Social Security? For someone who's in a low tax environment that's not paying tax on their Social Security, or only paying it at the 50%, then if we do something that takes them to the 85%, it might be something that helps with capital gains but hurts over here, and the net effect is it was wrong. That's why doing this tax analysis is great. And it's our strong opinion that if someone's in the 12%, and we don't have capital gains to harvest, that we'll then do a Roth conversion and take them to the top of the 12, but very seldom will we take them into that next bracket. There's more to it, like should someone do with their required minimum distribution, a qualified charitable deduction, HSA contributions. And so by us coming into that space with them, we fill yet another part of their financial planning, and that is in the area of tax planning. So from a best practice standpoint, we would encourage you to take a look at the tool. If you're not already doing this for your customers, I think you'll find great value and even increased referrals. From Financial Planning World, thank you, Rich, signing off.
Dan?
Have a great day.